Good morning, everyone, and welcome to our February edition of our Mortgage Quality and Compliance webinar. Very happy that you could join us today. This is Susan Milazzo. I run the California Mortgage Bankers Association and want to get us started. I know we were a couple of minutes late. I apologize for that, but I want to start off with a couple of announcements that we have, mostly about events that are coming up. On March 17th in Newport Beach, we have one of our free networking events at the offices of Wright Finley Zach. Immediately following that, on Monday, March 23rd, we have our annual legislative day up here in Sacramento. That's where we invite all of you to come and join us at our state capitol. We have a lunch presentation that's going to have some great content this year. I've got the National MBA is going to be joining us and providing a federal update as to what's happening in D.C. I have invited the Senior Deputy Ed Gill at the Department of Business Oversight to join us and discuss the DBO restructure this year. So really valuable content. There's a possibility, I'm trying to work out getting a representative from the No on Prop 13 campaign, which is the split tax roll campaign this year, to come and give us an update as to what's happening in that important issue, as well as the rent control ballot initiative. Both are issues that the California Mortgage Bankers Association will be active on this year. So very robust conference about advocacy, and enjoy all of you, would enjoy it if all of you could join us for that event. Two other quick events. Another free networking event coming up on April 16th in Los Angeles. That is hosted by Dykema. And of course, at the beginning of May, we have our Mortgage Innovators Conference coming up. We have just a fantastic lineup of technology solutions that are participating in that conference. You can see on-stage demos from about 40 different tech vendors. We're also going to be interspersing these tech talks and innovator insight sessions throughout the 2 days of content, where we're just going to be talking about the future of technology and its place in the mortgage industry. So we make it very affordable for lenders to participate. There is a buy one, get one free registration for lenders. So you can visit our website, cmba.com, on our events tab for information on any of those events. So with that, I'm going to turn it over to our lobbyist, Pat Zunzala. He's going to provide our legislative update and what we're focused on this year. So Pat, I'll turn it over to you.
Thank you, Susan. So before I talk about the issues, just to give you a sense of where we're at in the legislative process, last Friday was the deadline for normal bill introduction. So we had about 2,200 bills introduced by that deadline. So we're in the process of sifting through those, over 2,000 bills, determining what could impact the industry, et cetera. So today we're just going to talk about a few of those issues. The first one that I want to talk about is actually not a bill yet. It has to do with the governor's budget process. And really, first time I've seen this, but we had the governor put forth a proposal in his budget proposal, so essentially a plan to restructure the Department of Business Oversight into what they're going to call the Department of Financial Protection and Innovation, and then also as part of that establish the California Consumer Financial Protection Law. And the essence of the narrative at this point is that they want to do this. I think it's necessary to provide consumers with more protection against the perception that there's unfair and deceptive practices happening in a big way with respect to financial services and products. And so this will be this will allow for the DBO to have a better ability to go after those types of activities. And the key thing about this restructure and about the new law is that it would allow the Department of Business Oversight essentially to have authority, regulatory oversight, to go after any unfair, abusive, deceptive practices, and that's the department would make that determination when entities are providing financial products and or services to the public. And they've identified examples like in debt collection, credit reporting agencies, financial technology, fintech type entities that are, as an example, doing small loans over the internet without a license. They've provided those kind of examples. Basically what this is its establishment of something very similar to the CFPB at the federal level, but now at the state level. Much of the language looks very similar to Title X of the federal Dodd-Frank law. And one of the key things that this proposal will do, if it passes, is it would allow the DBO to develop regulations to enforce what they would call as unfair, deceptive, or abusive practices. This is a huge increase in the enforcement ability of the DBO, and though the narrative is they're going after these unlicensed activities or unregistered activities, the bill proposal would actually cover existing licensees. So covered entities or covered persons under this proposal could be existing licensees. And that's one of the things that we're looking at, trying to determine what kind of impact it would have and develop positioning around it. So stay tuned. It's very unusual to go through the budget, and the difference is it can move much faster, and if it is in the budget, it could pass by June 15th and go into effect immediately. So it's definitely something we're watching very closely. The next bill I want to mention very briefly is SB 908. This is a debt collector bill, and very simply what this bill would do is it would, for the first time, create a state-specific licensing requirement with respect to entities in the business of debt collection under the Rosenthal Fair Debt Collection Practices Act. So we're taking a look at that, and one of the things that we're already talking with the author about is there should be an exemption for licensed members of the CMBA, as an example, as far as hey, if you're already a licensed, a residential mortgage lender, as an example, or a California financing law licensee, you should have an exemption from the licensing requirement. And then the final bill I wanted to mention today is SB 1079. This is a very interesting bill. It comes out of some recent events in Oakland, Moms for Housing, dealing with situations where there were vacant housing, and essentially they took over some vacant housing. And the point of this from the proponents of this bill is they think that if there is vacant housing, you should be able to utilize it to help the homeless. But unfortunately, the bill really creates some sweeping ability to take over these properties. So just to give you a couple of examples, if a corporation owns a residential property, and residential property is defined as having one dwelling in it or more, and it's been vacant for 90 consecutive days, before you can sell that property on the open market, you have to actually offer it first to a new entity that they're creating. It's called a community land trust or a housing sponsor. And essentially the point of this is these types of entities will be designed to help homeless and to get folks into these properties. But it also would give eminent domain ability for these local governments to essentially take over these properties if they've been vacant for 90 days. So those are two things that the bill would do. And then finally, one of the other major things that the bill would do is in situations where you're having judicial foreclosure, a mortgagee must offer the property first to any tenant or association of tenants currently occupying the property, or second, to the city, county, or community land trust or housing sponsor before they offer it up in the open market. So some pretty dramatic authority and requirements put on these types of properties. So I think there's going to be a lot of controversy around this bill. That's it, Susan, as far as the issues that I wanted to mention.
Okay, thank you. Gosh, 2,000 bills. That was that is a lot to go through. And thank you, Pat, for that update. This is going to be a busy legislative year, so we'll have look forward to further updates on our future webinars. Next up, I'd like to introduce Michael Pfeiffer with Kirby and McGuinn, who's our general counsel. Michael is going to provide our litigation update. Michael, I'll turn it over to you.
Thank you, Susan. Susan, could you go ahead and go to the next slide? I've chosen to talk about this today because while it's not an actual case, it does impact the enforcement activities of the CFPB and also their supervision. So this is the CFPB policy statement on abusive acts and practices. Hopefully, most of you on this call have at least know about it or have had a chance to look at it. So I'm not going to spend a lot of time digging down into it, but it's important to recognize that this is a significant development in connection with the exercise by the CFPB of its various powers. And as Pat indicated, in California is seeking to expand its abilities. While our current statutes in California don't cover abusive practices, it wouldn't surprise me if the state, wanted to try to get involved in expanding that as well. So this couldn't be more timely. As I've indicated on this slide, the Dodd-Frank Act put into place what do we call a UDAP standard, unfair and deceptive and abusive acts and practices, as opposed to just unfair deceptive acts and practices. And since that inception of that statute, everybody's been wondering what is meant by abusive. The CFPB has assiduously declined to implement regulations on that, leaving everyone to sort of live in fear as to whether or not whatever they might be doing might be categorized by what is clearly a subjective test on what abusiveness means. And Director Kraninger in this press release, or the CFPB in the press release, makes the understatement, perhaps of the decade, that uncertainty remains as to the scope and meaning of abusiveness. And kudos to her and the current management of the CFPB in at least making an attempt to try to put some kind of rational curbs on what's meant by the term abusive. So next slide. Under Dodd-Frank, again, the standards under Dodd-Frank are if an act materially interferes with the ability of a consumer to understand a term or condition of a consumer financial product or service, or takes unreasonable advantage of any of the following three things: a consumer's lack of understanding of the material risks, costs, or conditions of the product or service. And of course, those of us involved in litigation on these things know that that's always something that the consumers allege, is that they didn't understand what they were signing up for. And there's always a challenge, so this becomes a question of fact to try to show that they did understand it. Another ground is the consumer's inability to protect his or her interest in selecting or using a consumer financial product or service. That one is a more fruitful ground for plaintiffs' litigation on this kind of thing. And the third one is a consumer's reasonable reliance on a covered person to act in his or her interests. A and B are difficult to, are easier to try to protect yourself because you can have disclaimers and you can have the consumers sign acknowledgments that they have understood these kinds of things. But B, inability to protect your interest in selecting or using a consumer financial product or service sort of focuses on the area prior to the selection of the service. And so that is a more subjective thing. It depends, it's a consumer by consumer thing. So that's a very broad and very sort of daunting standard to try to meet. Under the new policy statement, the CFPB at least tried to clarify what it means when it's using this. And so we'll go to the next slide for that. And it's three main principles that they've articulated. You can see this in the published guidance, and it's also summarized in the press release. And basically, the first one is whether or not the act or practice harms the consumers, and whether or not that harm is outweighed by the benefit of whatever it is the person is doing to the consumers. And you go, well, wait a second, that's kind of a strange thing to say. And it seems pretty obvious, right? It would be something that you would think that would just be intended all along. But it's finally nice to see them articulate that. There are things that you do that might otherwise be categorized to be, quote, abusive, but if there's a benefit to the consumer, then at least you've got the first leg of a defense. And you say, look, this is beneficial to the consumer. Show me that it's not outweighed, by harm. So that's an important thing to be in these standards. The second one is the practice in the past. I'm hearing somebody, I don't know, blow their nose or something. You might want to put your line on mute. In the past, basically the Bureau has, I think, in every instance, even though they've alleged abusive practices, they rely on the same facts as something being unfair or deceptive. Deceptive is pretty easy to prove, and so they've sort of fallen back on that. And unfair is a very amorphous kind of thing, but there's a lot of historical precedence on what is considered to be unfair. So what they're saying here is that, look, the CFPB is not going to just accuse you of abusiveness if all that really is going on is something that's deceptive or unfair. They're going to try to articulate in their enforcement and supervision activities something that's clearly identifiable as a separate act or practice that is abusive under the standards that are being articulated. And so they want to see a factual nexus between the appellation of the activity as being abusive and exactly what's going on. So that's another important standard. And finally, they say they don't intend to seek monetary relief for abusiveness where the person was making good faith effort to comply. I love that. I think that's good. Most of our members, and if not all of them, are trying to make a good faith effort to comply. I mean, there's an effort to try to do that. And as long as you're documenting what you're doing and you're monitoring it, you go a long way toward making good faith effort to comply. And what has been the bugaboo about this whole thing is everybody's trying to do their best and everybody's trying to comply with the law and as best they can understand it. And then to have the CFPB come in with some kind of, the great fear anyway, some kind of subjective standard that cannot be quantified, cannot be managed for, and say, well, that's abusive and we're going to fine you millions of dollars for this. So all three of these are important. And what I like about these is that presumably even the first principle, which is that the benefit to the consumers outweighs the harm, I think could help you in using the third standard as a defense. In other words, if you're showing that there's a benefit to the consumer in whatever you're doing, and you document that, that will be a good source of a good piece of documentation that might help your defense on a good faith effort to comply basis. So next slide. This is the statement that Director Craniger made. It's kind of a standard, plain vanilla, but I like the idea of at least putting in words the standard that they're trying to develop clear rules of the road and a policy to provide a framework for people to comply with. So next slide. That's my presentation, Susan.
Great. Thank you, Michael. I appreciate that information. Thank you for sharing that with us. We're going to move into this month's presentation, and in order to make that introduction, I'd like to introduce Raymond Schneitzel with First Line Compliance. Raymond is our Mortgage Quality and Compliance Co-Chair this year and will be moderating this portion of our presentation. So Raymond, I'll turn it over to you.
Thank you very much. Just something to think about as we go into this presentation. Even I'm a little bit shocked. If you stay in this industry long enough, the things that are never going to change apparently still do change. So I think this is one of the things we see now, and particularly with this topic, things you would never thought would go away or change actually is, and it's going to affect some of our business, of course. So as we usually do in this industry, we adapt. So to help us adapt, we have a couple of speakers today to speak on this subject. Our first one is Michael Flynn. Michael Flynn is with the Buchalter firm and is a member of the firm's corporate practice group in the Los Angeles office. Michael applies his unique background as the former acting general counsel of HUD and the former general counsel of PNC Mortgage and Flagstar Bank to counsel clients on a variety of regulatory, mortgage, consumer financial services, fintech, and real estate matters. Our next speaker then, coming after that, is Jennifer Schachterle. Jennifer is Senior Vice President of Warehouse Lending for Western Alliance Bank. She's responsible for growing the portfolio and supporting the client base by offering a wide range of services and solutions. She has over 25 years of experience in all aspects of the mortgage industry and previously held leadership roles with national banks and mortgage banking companies. So thank you both of you and welcome, and let's take it from there.
Thanks very much. This is Mike. Thank you very much, and I want to thank the committee and California Mortgage Bankers Association for giving Jennifer and me the opportunity to speak today. We're both very excited to talk to you about what's going on with LIBOR. Just as a little background, I'll first be going through sort of the background of LIBOR and some of the initial issues and what's been done about them. Jennifer is then going to talk about what Freddie and Fannie in particular are doing. Then we're both going to talk a little bit about some practical things to think about as we're moving towards the complete elimination of LIBOR. And as further background, I have for a few years now been doing a fair amount of work on LIBOR with various lending institutions and guarantors. So I have quite a bit of familiarity. And Jennifer, of course, in her position, having to deal with these issues in a more practical commercial sense. So I hope we'll be able to give you a good broad background. So what was LIBOR and what happened to it? If we look at the first substantive slide, we can see that LIBOR is the London Interbank Offered Rate, which is a rate measure that represents the amount that banks pay to borrow unsecured from each other. It, as of 2018, was being used in $260 trillion of transactions, including trillions in the mortgage space. So it's a very, very serious measure. There was a problem, though, if we go to the next slide. The data for LIBOR was inputted by banks voluntarily submitting information about the rates they were charging to one another. And in 2012, a rigging scandal was uncovered when it was believed that various people at various banks were feeding false information in order to create for their banks, depending upon where they tended to sit in the market, favorable rate information to help them drive deals that were economically beneficial to them, but not reflective of true market conditions. Also, that's obviously a problem that needs to be dealt with. And additionally, LIBOR was also being utilized less frequently as institutions started utilizing other forms of borrowing following the financial crisis and some of the rules changes. And additionally, generally, irrespective of the scandal, the number of banks inputting to LIBOR decreased very considerably, which made the data less broad, possibly less reflective of market conditions and what banks were actually doing. Let's move on to the next slide, which talks about the result of the scandal. Of course, as always happens in a crisis, the steps that need to be taken moved very, very slowly in regard to LIBOR. The scandal was first uncovered in 2012, and here we are in 2020, and we're not yet done with figuring out what to do. But what happened finally was the UK's Financial Conduct Authority, which supervised the banks in this area, announced that it was going to stop requiring reference banks to quote LIBOR by the end of 2021. Now, if LIBOR is not being quoted, it's not really available as an index for an ARM loan. I mentioned here in the slide zombie LIBOR because there was some indication that Intercontinental Exchange, which licenses LIBOR and gets a fee for its use, was considering not eliminating the publication of LIBOR in 2021, which could create problems if your loan documents, as many mortgage documents did, said that you can replace LIBOR only if it's unavailable, which is, we'll discuss in a little bit, that wasn't well defined. But it looks like ICE is probably not going to do that. It received a lot of pressure from the regulators to stop that approach. So that's probably not going to happen. In response to all this in the U.S., obviously some sort of new index for a wide range of commercial transactions and also for mortgage, residential mortgage ARM loans, they needed to develop replacements for LIBOR, and while they were at it, probably replacement for some of the language about indexes in loan documents. So the Federal Reserve Board and the New York Fed took the lead. They established the Alternative Reference Rates Committee, known as ARC. It's a committee consisting largely of representatives of financial institutions. Some of them are finance-oriented people, some are mortgage experts, some are compliance and regulatory types. It's a broad-ranging group of people from a lot of well-known institutions who worked very hard the last few years to try to come up with some templates to address these issues. So if we go to the next page, the issues they were looking at are ones that I think all lenders have been considering, and hopefully we're able to explain today where we are in resolving these issues. First is, what indexes will be best to replace LIBOR in various transactions, including in our case, residential ARM mortgages? Second, for future transactions, what language should be used in future transactions to describe the index? What language should be used, what index should be used, and what language should be used to allow for replacement of that index, given what we've learned about the language that was being used in regard to LIBOR and some of its vagueness. And additionally, for present loans that have LIBOR, what does the language in the document say about when and if LIBOR can be replaced, and which party decides that? And what does the language say about what types of index to use to replace LIBOR, and which party decides that? These are really key issues, and fortunately, as we'll talk, in the residential space, there tends to be pretty standard language because Freddie and Fannie language was used in most ARM loans, so a unified approach could be achieved. If we go to the next slide, the general rate that was developed really for all commercial activity was a Treasury repo financing rate known as the Secured Overnight Financing Rate, or SOFR. It's been published since 2018 on a daily basis. And further, ARC, along with promoting this rate that the Fed of New York developed, has proposed fallback language for syndicated business loans, bilateral business loans, floating rate loans, and now mortgage ARM loans. The problem with SOFR that still exists and really hasn't been quite resolved, I think personally, is it may not be ideal for all transactions. It's an overnight financing rate. That may not be totally reflective of market and long-term interest rate conditions in something like a 30-year ARM loan. Additionally, it's had a lot of volatility, including recently when, if you recall, the Treasury and the Fed had to start injecting funds into some of these overnight markets to stabilize some rate movements. There was a lot of movement in these overnight rates, which, depending upon when that occurs, if you're doing an ARM loan index that is adjusting every 30 days, depending on how often those swings occur and what the magnitude is in either direction, that could make month-to-month changes in an ARM index fairly significant. But for the time being, what they're trying to do, what the ARC is trying to do, is develop some overlays that may reduce some of that fluctuation and make an ARM loan residential SOFR more consistent. So let's go on to the next page where we start talking specifically about residential mortgage issues. As all of you know, ARM loans tended to use standard Freddie, Fannie language. And I've quoted the language here. It's significant, and I want to talk about it for a minute. Generally, the Freddie Fannie language was, if the index, and the index is defined elsewhere in the document as LIBOR, is no longer available, the note holder will choose a new index which is based upon comparable information. The note holder will give me notice of this choice. I've also noted that along with LIBOR, Freddie and Fannie have also used weekly average yield on U.S. Treasury securities as available by the Federal Reserve Board. This language is used for that index as well. It's standard. It has been the standard index language until now in U.S. ARM loan documents. Now, some banks may vary that for their portfolio type documents, but this is the language that has been used. If you look at it, you can see there are some problems with it. What does it mean that the index is no longer available? Regulators on both sides of the Atlantic have already identified LIBOR as deeply troubled. Yet, is it unavailable? It's still being published. The British regulators have announced it's going away. Does that make it unavailable now? Who knows? And then the note holder is to choose a new index based upon comparable information. What does that mean? What is comparable information? It doesn't say a comparable result. It says comparable information. The information going into LIBOR was what banks were charging each other on overnight unsecured loans. That's why I think they chose SOFR, which is a similar measure, because it's comparable information. But it does produce, given the vagueness of this language, it does produce a concern with some people that the next index will not trend exactly the same way we could have predicted LIBOR might have based upon historical extrapolations. Now, the language doesn't discuss that issue, but you could see where, to go back to the previous discussion a minute ago about unfair and abusive practices, if you replace an existing loan, a present-day LIBOR loan, if you replace the index with a new index, it doesn't really track the same way, and in some time periods favors the borrower, but in others favors the lender. Someone may claim that's unfair, and at least during certain time periods is very disadvantageous to borrowers, and that you didn't really have a basis under the existing language to make that change. The result is, I think, that everyone has waited for Freddie and Fannie and the Federal Housing Finance Administration to dictate what they're going to do. That will obviously drive the market, and everyone hopes provide some protection if there ever are legal challenges to all of this. Having that approval and directive of the U.S. government overseeing Freddie and Fannie being by far the two largest players, people think would give courts a chance to observe that this is the best and most reasonable solution and the only viable one, and therefore possibly avoid challenges that otherwise might occur. That seems like the appropriate approach. It's both practical for operational purposes and probably legally the best approach that could have been devised. So where does that take us? Let's go to the next slide. Freddie and Fannie have made announcements about where they are. They have been working with ARC regarding language and development of a new index, and we'll talk in a minute about what they've developed so far and what's coming. There was an ARC concept paper in July of 2019 that was published that discussed these issues in regard to residential ARM loans, discussed the new, what they call fallback language. That is the language that indicates when you can change to a new index for new loans. If we're going to have a SOFR index and that doesn't work out or goes away sometime, you want good language in your documents that says when they're going to, when you can change it out. So that's the fallback language that that paper talks about. It also talks about the actual SOFR rate and how it might be applied to residential ARM loans. A lot of it, that's a long exhibit, and a lot of it is very technical. I'm not going to go through it. I'm not a technical mortgage finance person, but if any of you are interested, it makes for some interesting reading about how we've ended up where we are and where Freddie and Fannie are going forward. Freddie and Fannie are marching very tightly with ARC. They've been very supportive of ARC, and if ARC indicates things should go one way, Freddie and Fannie and FHFA are very likely to follow in line. On November 15, 2019, ARC released its recommended contractual fallback language for LIBOR-denominated closed-end residential ARMs, very specifically for the kind of products we're talking about today. And Freddie and Fannie not only intend to use that language, they've already developed it to some of their documents. So let's look at what that language is on the next slide. The ARC's recommended fallback language, which Freddie and Fannie are adopting and already putting into forms, states that there are two triggers for residential ARM indexes. One is when the administrator has permanently or indefinitely stopped providing the index to the general public. The administrator is defined in these documents. That would be the party that's actually gathers information and publishes it. In the case of LIBOR, that was ICE, but in the future, the administrator may be a government agency like the New York Fed or ARC itself. But the administrator, if the administrator permanently or indefinitely stops providing the index to the general public, it would be deemed to trigger the non-availability of the index. And when the administrator or its regulator issues an official public statement that the index is no longer reliable or representative. This is important because if you remember a few minutes ago, we talked about the fact that the current kind of LIBOR language has been used for many years. Simply said when the index becomes unavailable, you can change it. But it didn't define what unavailability means when a regulator doesn't like the index anymore, but the party creating the index is still continuing to publish it or the data is still out there. The second bullet point here is designed to address that issue by saying, in addition to the index actually not being available, if the administrator or its regulator, in that case that would be the U.S. banking agencies for our purposes, issues some sort of official announcement that the index is no longer reliable or representative, under these new loan documents, lenders will be able to move off of that document, lenders and servicers. That's a very significant change. It's a very strong tightening up of what was a pretty vague issue, and I think everyone agrees it's an appropriate step. Then ARC has also recommended, developed, and Freddie and Fannie are adopting a waterfall for replacement index. In other words, if they adopt this a sort of a modified SOFR, and then something happens 3 years from now, 10 years from now, that disappears, what do you replace on then existing loans? What do you replace an index with? As we discussed a few minutes ago, the language that was traditionally used in regard to LIBOR was extremely vague. It was from an index based on comparable information, which is not well defined at all. So instead, they've come up with some specifics. An index selected or recommended by the Federal Reserve, the Federal Reserve Bank of New York, or ARC. This is an indication that the federal government and the Federal Reserve are trying to keep control of this rate issue in our markets, and that they're going to be willing to step in when they think that if for some reason an index needs to be replaced. If there's a new scandal, if it proves that index is just too volatile, they will have the ability under these loan documents to step in and declare that the new index, a new index is needed, and that what should be used is the one they're recommending, if that's where they want to go. A second possible waterfall, if they don't take that step, is an index selected by the note holder. It can have adjustments to the margin related to differences between LIBOR and the new index. I don't think that part about the margin related to differences between LIBOR and the new index is going to be very relevant a few years from now, but it's still in there to protect everyone. And ideally, your institution would never get to the point where you feel a need to move off of this new index under these new form documents, and the Federal Reserve, the FRB of New York, or ARC haven't acted to provide a designation of a new index. I don't think many institutions want to be the first ones out of that box. I think they're going to wait for the government. So now I'm going to turn over to Jennifer for a few minutes to discuss specifically what Freddie and Fannie are doing before we talk about some practical implementation issues. Jennifer?
Thanks, Mike. Yeah, so we know how we got here, and now we're starting to hear from the agencies on what you as lenders need to do to address the changes. Fannie and Freddie recently came out at the beginning of February with lender letters to discuss the changes to the fallback language and also the retirement of LIBOR in the notes. Before we go into that, I will say, for those of you who haven't read this information or the things we're referencing in this deck, we provided a handout that has a lot of these documents in them. But I will suggest the FHFA has done a great job on their website, fhfa.gov, under supervision and regulation, of creating a LIBOR transition page. And that page has links to all the news releases from the agencies. It also has links to the ARRC's white papers on the transition and also the fallback language, and also other links. So CFPB has a blog where they commented on it. You can find all of that on their page. It's also subscribable. So if you go to the bottom right-hand corner of that page, you can get email updates anytime they update their communication that may come from any one of these different lenders. So it's a great resource page as you're trying to keep track of where this is all going and what needs to change on your side. So Fannie and Freddie came out on February 5th, basically to announce that they're ready to implement the notes, ARM notes that will have the new fallback language. The language is effective, and they're encouraging lenders to use the updated documents immediately, but they need to be used for loans closed on or after June 1st. So all the Fannie Freddie joint uniform ARM notes and riders have been updated, so they're available. They've also announced that the retirement of LIBOR ARMs is coming. So by the end of 2020, they're no longer going to acquire loans that are indexed to LIBOR. They anticipate the SOFR ARMs, that deliveries of those will be accepted later this year, but haven't announced an official date on that. So I would go to each of those lender letters just to clarify and make sure that you're in compliance with those. The one thing that's not addressed here that you will need to think about is, there is non-QM and jumbo loans and other loans that are being done that may not be sold to the agencies that need to have that language as well. So I would encourage you to work with your investors or legal and compliance to make sure that, you've got the applicable fallback language, and then as it transitions from LIBOR to the new rate, that you know that your loans have the correct language for those to be sold to others besides the GSEs. I think that covers these two slides. One's a Fannie slide, one's a Freddie slide, but as I mentioned, the handout has references to these letters, so it'll walk you through any additional information. Mike?
Thanks, Jennifer. And Jennifer's right. The exhibits that are the letters from Freddie and Fannie are pretty specific in detail and even lay out a lot of information about the types of products they're going to be offering with a new index. They can't give the actual index, but they're showing margins for different type of products and things like that. So it's definitely worth taking a look at that to see where that's going. I'm sure most of you already have. The next slide talks about some remaining residential mortgage issues. And the first one is any restrictions on changing the index in investor transaction documents. You know, when Jennifer and I talked about this, we saw a couple of different issues. One is if you do have residential mortgage-backed securities that are out there, you may need approvals of various parties depending upon what your documents say. It's important that your team reviews those documents carefully for the changes that might be made on existing loans, given the language we talked about earlier that's so vague. Additionally, if you have flow sale agreements and those agree with the investor requirements are such that they talk about using LIBOR as an index, that's going to have to be addressed. Or if they're very vague about the indexes, you should take a look at those and make sure that the parties you are selling loans to are comfortable with that. If you're a large seller of loans and you have form transaction documents that you give to new potential purchase investors, you've got to review those and make sure that they address these changes, that they're not still referring to LIBOR or any of the conditions related to the old LIBOR language, and that they're picking up the new language in the Freddie and Fannie forms and the new information released by ARM. And then there's a question of informing borrowers. Obviously, on new loans, borrowers will be given all the disclosures they're supposed to be given under TILA, RESPA, et cetera, and so we'll get information about the cost of the loan. But what about existing loans where borrowers are currently operating with an ARM LIBOR index? We know that index is going to change soon. I haven't seen anything from any trade association, government agency, regulatory overseer that has recommended what, if any, language should be given to borrowers who are currently operating under LIBOR. But I think everyone should keep their eyes out for what language might be proposed just before the transition away from LIBOR to any new index, which will come once LIBOR goes away. You're going to have to notify people. I think people should focus on, perhaps ARC will give some recommended language, perhaps Freddie and Fannie will, or perhaps the national MBA will. But it's going to have to be clear to borrowers, but I don't think anyone wants it to be complex and confusing. That's just going to open a Pandora's box of confusion. So that's something to keep an eye out for and to take a look and have your compliance and operational teams consider when and how you might implement any such disclosures that come along. There's also the question of what to do on current new loans. If anyone is still making a LIBOR loan, there is an issue with the fact that you're making that loan knowing now that it's going to go away sometime in the near future. That index is going to go away. Now, the TILA disclosures don't necessarily require you to reveal that, but as a sort of a general fair practice and then from a sort of a UDAP perspective, shouldn't you be advising clients, our customers, that the index you're giving them now might in 2 or 3 years on a 30-year loan change? And the MBA looked at this and developed a model disclosure form, which is shown on it. We've included it in Exhibit D. And it's clear, it's fairly simple. Many lenders have adopted it starting, months ago. Some have not. I'm not going to opine as to whether you should or not, but we thought it was worthwhile to show it to you in case you haven't considered it already, as to whether this is the kind of disclosure you want to give with your loan origination disclosures to make sure borrowers understand that the loan they're getting may change. Now, if you've already moved off of LIBOR and you're using a Fed rate index or something, this is not an issue. But if you're still using LIBOR, this is something you may want to consider for the next year or so, that before the LIBOR index on these new loans you're making shifts out. The next slide talks about some practical implementation issues, and I invite Jennifer to jump in with me here on this particular slide because she has some really good perspectives, I think, as a person who works operationally and transactionally in this area. I'm just a lawyer who sees everything in sort of a black and white way. So obviously, as an overarching consideration, it looks like a lot of these changes to the documents and the rates are going to come pretty quickly at the last minute before LIBOR goes away. I mean, to my point earlier, this has been going on for 8 years. Now we're, a little over a year and a half away, and we're just now getting forms created. And that's not a long time for mortgage operations to make the changes they need, and mortgage servicers to make the changes they need for tracking indexes. So I think your teams are going to have to gear up to be able to assess what changes are needed in the systems and your models and other operational processes. It'll be triggered by the LIBOR phase out and the phase in both of the new fallback language and the phase in of the new index. And that these things will probably happen fairly quickly. Freddie and Fannie are going to try to get any guidance, any new forms out as fast as they can, get the new indexes set. But they have to wait for FHFA to tell them what to do, of course. And that's even for something as simple as the fallback language, that took a very long time. So you can imagine that getting these finalized product forms and product processes done could drag along and only be resolved at the relatively last minute, which puts all of the people in the industry in a position of having to look at it very quickly. Your accounting systems, your loan generation systems, your pricing models, your risk models, all of your management information systems are going to require review and change. And then you're going to have to build all that into your oversight, compliance, quality control, quality assurance, internal audit testing, compliance testing, because we know that your regulators are going to be looking at this very, very closely. This is obviously a gigantic issue. So you're going to take all of this information. Jennifer, your thoughts?
Yeah, I mean, you're absolutely right. And I guess the good news is for all of us that have been in the industry for a while, we've gotten really good at implementing big changes. I think we all learned after non-QM and changing the residential loan application, there's a lot of changes we've had to deal with. And so this is just another one that's going to require putting together a team, having a plan, knowing where you need to go to find the answers, knowing what your deadlines are, knowing your deadlines might change, knowing the other things might change. So, I know that those of us that have been in the industry know how to get through this. I will make a plug though for our Mortgage Innovators Conference that's coming up. I mean, in this day and age, we all have a lot of vendors that do a lot of different things for us within our business. And that conference is a great opportunity to see a lot of people at once. And so if you want to find a way to come out and touch all of the different people that may be touching your process to make sure they're all, have a plan in place and know what their tasks are to make sure this gets implemented correctly, I would definitely come to that conference. It's a great way. And maybe there's people there that have services that can help you on this that you're not using today. So it's, again, just making sure you have a team, making sure you have a project plan, making sure that you're, on time with your dates and targets to get things implemented will be the key to the successful migration over on this.
Okay. Jennifer, do you want to touch on the last two slides, some of these practical other considerations?
Yep. So there's a couple other things people need to consider. There's a lot of places that LIBOR is being used as an index for borrowings beyond just residential mortgages. Many lenders have warehouse lines or other debt agreements that may be tied to floating rates that are using LIBOR. So you want to make sure that you're pulling those out and reading through them. Many may already have fallback language, or you may see fallback language that's implemented as you go through renewals. But it's good. It's good to be talking to your relationship managers or bankers, knowing what their plan is and what you're transitioning to, because just like borrowers are concerned about what their cost of funds is going to be on borrowings, you will be as well on the debt that you've taken out. So I would definitely pull out all of your agreements, make sure you know which ones are tied to LIBOR, and then start those discussions. The next slide is just an overview of what banks are doing and what they're required to do. Essentially, they have to have project teams in place. Banks obviously are going to have to go through all of their lending agreements, make sure that they're tracking to get things done as well. And I think that's happening, although I would say most banks in general have not put out specifics on, how and when it will move to SOFR. But I will say most have created fallback language. Some have even changed maybe the terms and have gotten away from LIBOR altogether and gone to a different index. But something to be aware of and keep on your radar as all of these changes go through, because it will impact your business, not just the loans you're originating.
And Jennifer, I just wanted to add in regard to your comments about the warehouse line of lending, warehouse lines of credit, note financing lines, and other means of doing mortgage financing for originators. Those kind of commercial agreements, that market has moved faster than the mortgage ARM market has, and a lot of commercial lending institutions are far along with their alternative language and their selections of how you may choose new rates and that sort of thing. So keep that in mind. What we're talking about here in terms of the language within the mortgage documents that we're referring to may not be exactly what's going on with the commercial lenders who are giving you financing. So you have to tie your commercial folks in on this as well.
I think that's our presentation. If there's questions, we're happy to, if we can, answer any questions that you all might have. I think you can type them in through the.
Yeah, absolutely. And thank you, Mike and Jennifer. That's a lot of information to cover. I think you guys did just a fantastic job. I'm trying to put both your respective contact informations up on the screen so people can see those. I can also provide those to any of you. But as Jennifer and Mike had noted, we are certainly able to take your questions. If you want to type them into the questions dialog box, I can pose them to our speakers. There's been a couple of messages about the webinar. We do record these webinars, and they will be available on our website. Probably we get it within the next couple of days. So maybe by tomorrow, if not by Monday at the latest. So again, if anybody has any questions for Mike or Jennifer, we can take those questions now. You can type them into the questions dialog box, and I can provide those questions to them. While I'm waiting for some questions to come in, I will remind everyone that our topic for next month will be highlights from the NMLS conference, and our featured speakers will be Tracy Bai from Plaza Home Mortgage and Rosalind Hardy with QCP Systems to talk about some of the more salient points that were covered at last week's NMLS conference, for those of you that might have missed it. One last reminder is that if you these webinars are monthly on a variety of compliance topics. They're free to anyone in the industry. If you received the webinar information from a colleague and would like to be added to our email distribution list, please email me directly at susan@cmba.com, and I will get you added to the future email distribution list. There is a question about the exhibit documents. If you look on your right-hand side with the menu, there is one tab that says Handouts. If you open that tab, there's a PDF that you can download that will give you the exhibits that Mike and Jennifer referenced during their presentation. And if anybody needs that, can't see it, yeah, I can get it to them.
Yeah, or all the documents we have there are also on the FHFA site on the links on their LIBOR transition page as well. So there's a couple places people can go to get the info.
Couple places to get, and as you mentioned, they can also get on the distribution list for updates. So that's a great takeaway as well.
Yep.
Okay, well, it looks like that concludes today's webinar. Thank you, Mike and Jennifer, Pat and Michael, for all of the information shared today. And for those of you that can join us next month, we'll talk with you again on March 26th. Have a great rest of your day. Thanks for joining us.